Hi, everybody. Welcome to On the Money. I'm Maria Bartiromo. A stunning move by the Federal Reserve, what it didn't do and what it means for your portfolio for the long and short term. I'll have a rare interview with a voting member of the Open Market Committee at the Fed. We'll find out what happened inside that room, where the decision was made and why. Then, 5 years after the financial crisis, lessons learned, and one woman who was at the center of the storm. Why she says more still needs to be done. On the Money begins right now.
This is America's #1 financial news program, On the Money. Now, Maria Bartiromo.
Here's a look at what's making news as we head into a new week on the money. For months, the markets had been watching and waiting for the week's Fed meeting, but the Fed did what very few on Wall Street expected, nothing, saying it needed more evidence of an improving economy and citing concern about a fight over the debt ceiling and the continuing resolution in Washington. The Fed chose not to slow down the bond buying program of $85 billion a month. And with that, the market soared. The Dow and the S&P 500 went to all-time highs on Wednesday, and the Nasdaq hit a 13-year high as well. But the indexes pulled back and took a breather on Thursday. The markets fell on Friday. JP Morgan Chase may be hitting its own ATM for a while. The banking giant is paying a whopping $920 million fine to regulators for the so-called London whale trade. The company did admit wrongdoing, but no top executives were blamed in the settlement. In earnings news, FedEx beat analysts' expectations, as did Oracle, though Oracle's revenue was light and the company had a disappointing outlook. We will bring you my interview with Oracle founder, chairman, and CEO Larry Ellison in a couple of weeks here on The Money. The Federal Reserve opted to keep its foot on the accelerator and continue the monthly bond buying program, saying that there's not sufficient evidence the economy has recovered to back off just yet. Joining me now, a man who was in the room for the Fed's two-day meeting, voted for the no-taper, St. Louis Federal Reserve Bank President and CEO James Bullard. And Jim Bullard, it's great to have you on the program.
Thanks for having me. I really appreciate it.
Thank you so much. So everybody was waiting and watching for the Fed to announce that they, in fact, were beginning to taper. You voted no taper for this time. Why? What was behind that decision?
Well, I think it was a close call, but basically what happened was when we laid out this roadmap in June, what we said was we were looking for a stronger economy in the second half of 2013. And so far, we're only partway through the third, I guess most of the way through the third quarter, and the data's been a little mixed, and it doesn't really look like the things that we were looking for in June are really materializing, at least not yet. And so I think the committee just came down on the side of let's wait and see. And one of the things that helped us, I think, or at least for me, is that inflation's running low. So we can afford to be patient here. Unemployment has continued to tick down. One of the things about the recent report, the recent employment report, was that unemployment went down, but labor force participation went down. So it kind of went down for the wrong reasons, and I think that weighed on the committee's mind as well.
The participation rate, certainly really critical. So the participation rate, it's at a 30-plus year low. What do you think is going on? Why is it so low?
I think it's a great question. One thing about this issue is you have to keep in mind that the participation rate has been declining since 2000. So this is a 13-year process. This is not just associated with the recent recession and recovery. And a lot of that is demographics. It's you can put a demographic model on that, and you'll get most of the decline in labor force participation.
How significant would a $10 billion tapering be, going from $85 billion in bonds to $75 billion? Is there a chance we could see that, for example, next month?
Well, I do think October is a live meeting. We have had press conferences at certain meetings and not at other meetings, but the chairman did say that we could, if we wanted to, arrange a press conference for the October meeting. So I think that part could be handled. I've been one that has said that we should have, all these meetings should be ex ante identical. They should allow the committee to make an important decision if the committee feels like the data is there. One thing about October versus now is that people are saying, which is very legitimate, is how much information is really going to come in. In my mind, that's okay, because that's always the question in monetary policy. We meet 8 times a year, and we always get only a little bit of incremental information on the economy at each meeting. As to whether we'll take action there or not, I don't know, but it is a live meeting, and it is possible that we would move.
Let me ask you about sort of the mood in the room that day. There was one dissenting vote, Kansas City Federal Reserve President Esther George, who has a history of opposing Fed stimulus, I guess. What can you tell me about being in the room while the debate is happening? Is the discussion passionate? Were people disagreeing with Esther George? How did that go down?
Well, I suppose it's passionate, but it's sort of economists being passionate, which is probably not very passionate.
You guys got to get out more.
No, people do have strong views, and they do feel, it is an important decision, and they want to get their views on the table. That's for sure. And but I think the chairman guides the discussion very well, and people rally around the chairman in the end.
Looking back at QE, and certainly the QE's third go-round, what has been the effectiveness of the program in your view?
I think that the cumulative evidence from September of 2012, which is when we started QE3 here, is pretty strong that labor markets have improved. So unemployment has come down quite a ways. It'll probably continue to tick down. If you look at the unemployment claims numbers, they're real low. Jobs growth has been stronger over the last 12 months than it was in the 6 months or 12 months before QE3 came along. So I think we have had an impact there. It's just probably not as much as people might have liked, but it certainly has been a positive impact. You can look at other things too. I mean, equities are this idea of keeping risk-free rates fairly low and then pushing people into riskier assets, that has occurred in spades this time and with the other rounds of quantitative easings.
You make a good point in terms of the stock market, because the market's been on a great run during QE3. And is that the wealth effect that you look at? It makes people feel better.
Yeah, and I didn't mention housing prices, but the housing market and interest-sensitive sectors in general have been much stronger over the last year. So I think that has often been taken as evidence that this is having a big impact. So autos are better, housing markets are better. And then when rates went up in the summer, it looked like the housing data got a little softer.
Let me ask you about that, because rates, we're watching the 10-year so closely, getting up to 3%, or close to 3%. Does that have an impact, do you think, on the housing market?
I don't know, I don't know when you got your first mortgage or something, but the rates were much higher historically.
Absolutely.
So they still look ridiculously low.
They really do.
But I think for somebody that's on the margin and they were thinking of buying, a certain house at a certain price and a certain interest rate, and then the interest rate shoots up on them, they're going to have to reformulate their plans. I think the biggest thing about housing markets is that the notion that was around maybe 18 months or 24 months ago that there was another leg down in housing prices, and that the housing market is still more foreclosures coming out of the market, all these kinds of stories that housing market was going to go down again, prices were going to head down again. All of that has been swept away in the last 18 months, and things are up. Some markets, they're up a lot, and so I think the psychology in housing markets has changed quite a bit. Everybody's
asking, of course, who will lead the Fed next. You've worked with Janet Yellen for years. Can you talk to us about the difference in terms of Janet Yellen versus Ben Bernanke? Would policy be much different if, in fact, she were to get the job?
Well, I wouldn't want to prejudge what she would do should she get the nomination and be confirmed. It's up to the White House to make a decision on this in conjunction with the Senate. So we'll see what they do. If she does get the job, she'll want to outline her own strategy and not have me doing that. So we'll give her the opportunity to do that. But I will say, in general, no matter who the chairman is, I think there'll be a lot of continuity in policy. It's not the kind of thing that changes abruptly. It's a big committee. There are a lot of people with a lot of experience and a lot of expertise on the committee. So I would see it as a slow-changing kind of thing. And obviously, Jan has been right in the middle of the action for quite a while. So I would expect a lot of continuity here.
Would you have liked to work with Larry Summers?
I don't know him that well. I've met him a few times, so I just don't have very much experience working directly with him.
And let me ask you your assessment of sort of the next year. I know it's data dependent. You've said that. Ben Bernanke has said that. But what would be your expectation of the economy in terms of the growth pace in the next year?
I'm still optimistic, even after my optimistic forecasts have been dashed.
All right, Jim, great to have you on the program.
Great to talk to you, Maria.
Thank
I really
you.
appreciate it.
And we appreciate your time. St. Louis Federal Reserve Bank President and CEO James Bullard joining us. Up next on The Money, what does the Fed's stunning decision mean to your money and the markets? And by the way, that's not all that's going on in Washington. What to watch for, what might happen next. And later, we take a walk down memory lane to Wall Street, revisit the financial crisis on the 5th anniversary. What are the lessons learned? What's still left to do? That's coming out with former FDIC Chair Sheila Bair.
With the Federal Reserve knowing how pivotal the events in Washington are going to be in October, it may have forced them to delay any decision of tapering until late October or November.
That was BlackRock Chairman and CEO Larry Fink telling me why he thinks the Fed did not taper this week. There are plenty of theories going around, but how does the Fed's non-decision affect your portfolio and money? Joining me now are Robert Zagunis. He's portfolio manager of the Jensen Quality Growth Fund, a four-star Morningstar fund with $6.5 billion in assets under management for the whole firm. Also with us is Greg Ip, economics editor at The Economist. Gentlemen, good to have you on the program. Thanks very much for joining us.
Thanks for having us.
So, Robert, you were not surprised. You were not expecting tapering. Is that right?
That's correct. They've indicated that employment has to get to 6.5% as a target, and 6.5% versus 7.2 or 10.2 if you use a full participation rate, it's a long ways to go. So they're not even close to getting to where they want to get.
Right. And Greg, I know that you are probably going to say, well, the 6.5% target was really in terms of moving interest rates.
Right.
But I feel like once Ben Bernanke came out with a marker of 6.5%, that's what everybody was focused on. And that's exactly why I agree. I was not expecting the tapering either. What about you?
I was surprised. Most of the street was surprised. In June, Bernanke had said that even though they were going to keep the short-term rate at zero, at least until the federal funds, at least until the unemployment rate came down to 6.5% or lower, they had suggested that their separate program of buying bonds by printing money, what they call quantitative easing, that would begin to taper by the end of this year, and that they hope to be done when the unemployment rate was down to 7%, which they expected around the middle of next year. The surprise wasn't so much that they decided not to go in September, but the body language from Ben Bernanke at his press conference that they might not go in October or December either. And that leaves us all kind of scratching our heads.
Actually, we just heard from James Bullard a few minutes ago at the top of this show, and he said a tapering is possible in October. Now, of course, the economic data is not going to change all that much. But, Robert, does this change over the short term how you invest?
Actually, what doesn't get talked about a lot is there's a sector of the market, a certain type of company, the quality growth companies that we invest in, that really don't benefit from short-term interest rates. In fact, if you think about companies that have been very profitable through the economic down cycle and have a high return on equity, they've been generating so much cash that their balance sheets are actually fat and almost too strong in some ways. So for them to have cash and short-term investments at very low, maybe artificial rates, is a detriment for them.
But, Greg, let me ask you about what's to come in Washington.
Yeah.
I mean, we'll likely see a battle over the continuing resolution to fund government spending, the debt ceiling to pay for spending that's already occurred. Chairman Bernanke spoke about this in his news conference, and James Bullard just told us this is something that they discussed behind the closed doors. How do you think this plays out?
Well, it's a pretty important factor, as you just suggested. It doesn't matter just for the budget, but apparently matters for the Fed as well. Getting past this next period of budget confrontation will be important to the economy staying on a stable path and giving the Fed the confidence it needs to taper quantitative easing. Right now, I'd say the signs don't look very good. The House is about to pass a budget that funds the government but defunds Obamacare, and the president says he'll veto such a bill. It'll be in the laps of the Senate to try and take that bill, strip out the Obamacare language, and then send it back to the House. And then, really, it will be a test of John Boehner's leadership. He's the Speaker of the House, whether he can put that bill to the House and be willing to pass it with just a minority of his own caucus and the help of Democrats. I think he will do that. He did it earlier this year when it was necessary to avoid big tax increases, but it's big question marks, and this one could come down to the wire again. Same with the debt ceiling.
Once again, we're coming down to the wire. The last time we came down to the wire like this, the markets didn't like it. Are you expecting volatility? Are you expecting a sell-off going into this moment?
Yeah, there's been a lot of volatility, and that'll continue. You know, I'm confident that once the dust settles, the resolution will occur. There is one interesting point about this quantitative easing and low interest rates. It usually helps the debtors. And who's the bigger debtor than the U.S. government? So what you have is a situation where low rates continue to help the debt service for the public debt of the U.S. So to some degree, that's a small benefit that sometimes gets overlooked.
Greg, the other big story, of course, who will replace Ben Bernanke next year now that Larry Summers has withdrawn his name? Janet Yellen seems to be the front runner. How do you think this plays out?
Well, yet another surprise in a week full of surprises. Yes, Larry Summers, who most people believed was the president's preferred choice to lead the Federal Reserve, did pull out a week ago. And the signals from Washington now are that Janet Yellen, who's currently the vice chairman, is the front runner to replace him. I think that comes as a big relief to the markets because Janet Yellen, who's been vice chairman since 2010, with the Fed for many more years than that, has been part of the decision-making process that has given us quantitative easing and all the various signals on on short-term interest rates. So I think it's a safe bet that if she is a nominee, you will have continuity in Federal Reserve policy.
All right, we'll leave it there. Robert,
Thank you.
Greg, good to have you on the program. Thanks very much. Robert Zagunis, Greg Ib. Up next on The Money, we hear insights from one of the leading ladies of the financial crisis. She helped lessen the damage in 2008 by staving off a run on the banks. I'll talk with former FDIC Chair Sheila Bair about too big to fail and the new regulatory environment after this break. And I hope you'll find us on Facebook, Facebook/Maria Bartiromo. Back in a moment. Well, it's been 5 years since Lehman Brothers fell, an event that sparked the 2008 financial crisis and sent the country into the Great Recession. What happened and how safe is our financial system today? Joining me now is former Federal Deposit Insurance Corporation Chair Sheila Bair. She's a senior advisor for the Pew Charitable Trust. Sheila, good to have you on the program. Welcome.
Thanks for having me.
So
nice to be here.
Where are we 5 years later in terms of regulation? Do we have the necessary measures in place to head off another financial crisis?
No, I don't think we do. The system is safer than it was, but it wasn't very safe leading up to the subprime crisis, so that's not a very strong baseline. I think the system still relies on too much leverage, too much short-term debt. Money market funds have not been reformed yet. Securitization, a big driver of all these unaffordable loans, that's not been reformed. So there's still a lot of work that is left that needs to be done.
Well, I mean, the Dodd-Frank bill was supposed to solve too big to fail and reform the financial industry, and yet assets at the 10 largest U.S. banks are up. They've grown, what, 28% to more than $11 trillion since the crisis. I guess two-part question. How come Dodd-Frank has not been implemented? It's only, what, halfway there? And is Dodd-Frank not enough to rein in the banks?
Well, I think there's been a lot of tremendous industry lobbying against it. That's frankly one of the fallouts of the bailouts is that we propped everybody up, we kept them going, there really was no accountability, so that's been a problem. But we need more leadership, frankly, at the regulatory agencies. We need more political support from the president and the Congress to get these rules done.
And yet we're seeing enormous numbers in terms of the cost. I mean, what about the expense? J.P. Morgan paying another $4 billion for the second half of this year to comply with the rules.
You know, that's really, the London Whale has been the lion's share of the fines there. I think all these enforcement actions are justified against J.P. Morgan Chase, but I don't think they're unusual in some of the things that they're doing. And frankly, I'd like to see, you know, more of these types of actions brought against other institutions where I think you have similar problems. On the other hand, I think, you know, some of the regulatory activity, it's not clear to me how much incremental benefit there is to it. But, you know, for instance, the stress tests have been helpful, but I think they're spinning out of control a little bit now. And thousands of pages, even the smaller regional banks and the hundreds of staff that have to deal with this. And are they focusing the banks on the right things?
So, I mean, what about the Volcker Rule, for example? I mean, 3 years after approval, the Volcker Rule, which is supposed to stop banks from being both an advisor and a creditor to client, it's still not finalized. There have been reports of infighting among the separate agencies, which are supposed to decide the specifics of this rule. Is the Volcker Rule too difficult to even write? How are you going to enforce something you can't even explain?
Well, I think I've written on this before, I think there are ways to simplify and strengthen that rule that are not hard to do. And the interagency disagreements, there's really no excuse for that. These are all grown-up adult people, very senior level people, appointed by the president, confirmed by the Senate. They can't get in a room and get this decided. I think it's quite problematic. So I don't let them off the hook on that.
And the FDIC is more powerful than when you left it. Is the idea that the FDIC can roll down an institution, is that a game changer?
I think it is a game changer. I think the FDIC's done, they do have the rules in place, the claims priority, explaining how the process will work. You're seeing some market impact already. Funding costs have gone up a bit. Their credit ratings agencies have downgraded them somewhat based on the assumption that at least government support is less likely. So I think there's been tremendous progress, but there are two important things that they can do to make sure that we have ended this pernicious doctrine. One is use the authorities under Title I of Dodd-Frank, which is joint with the Fed and the FDIC, to force these mega banks to simplify their legal operations, make it easy to sever their investment bank, their derivatives trading operation from their commercial banks, wall off to insured deposits from those higher risk activities. The other is to force these large financial conglomerates to issue more long-term debt at the holding company level that can be readily converted into loss-absorbing equity if they fail, so you have enough money to absorb losses and recapitalize whatever clean bank emerges out of the receivership. So those are two very important things.
Absolutely. Sheila, good to have you on the program. Thanks so much.
Thanks for having me.
We'll see you soon. Sheila Bair. Up next, a look at the news this upcoming week that will have an impact on your money. As we take a break, take a look at how the stock market ended the week. Back in a moment. For more on our show and our guests, check out the website, otm.cnbc.com. And I hope you'll follow me on Twitter and on Google+. Look for @Maria Bartiromo. First, though, take a look at the stories coming up in the week ahead that may move the markets and impact your money this week. On Monday, Goldman Sachs, Nike, and Visa will be joined to the Dow Jones Industrial Average. The index is kicking out Bank of America, Hewlett-Packard, and Alcoa. On Tuesday, we will see if home prices continue to rise when the S&P Case-Shiller Index comes out. Then on Wednesday, we've got the report on new home sales for the month of August out. On Thursday, the third estimate for the second quarter GDP will be released. That's typically a market mover. That'll do it for us for today. Thank you so much for joining me. My guest next week, special program, we'll talk with former President Bill Clinton. Each week, keep it right here where we are on the money. Have a great week, everybody, and I'll see you again next weekend.